Today, we are going to discuss a unique financial strategy called the infinite banking concept, or IBC. Hello, everyone, and welcome to another 2024 podcast of It's Your Life. Today, we are going to discuss a unique financial strategy called the infinite banking concept, or IBC. And as always, our goal on these podcasts is to help you improve your life, your family's life, and your legacy. So, infinite banking concept, what is the purpose of this? Well, I'm going to let Shannon really tell you more, but basically, it's intended to put you in control of your personal finances, essentially by becoming your own bank. So this is really fascinating and really beneficial. And I'm going to turn it over to my partner, Shannon Carpenter, because he is the IBC expert. So Shannon, take it away.
You got it, Paul. Thank you so much. So, infinite banking is a good buzzword that's going on right now all over social media. People are wanting to learn more. They're wanting more of an education on this topic and to find out exactly what it is and how they can use it. So I'm just going to share with you, this is a training that I use with agents to explain to them how it works and to show them the benefits of the system. So I thought we'd just use this. So first of all, infinite banking is nothing new. It's been going on for hundreds of years. But we didn't call it infinite banking until really Nelson Nash wrote this book. And if you don't have the book, I recommend you pick it up or maybe get it on audio tape and listen to it. But in his words, it's becoming your own banker, or BYOB as we like to call it. So what exactly is infinite banking? Well, first of all, infinite banking is not necessarily a product, it's a process. Usually we use a dividend-paying whole life insurance policy issued from a mutual company, and I'll explain why that's important. To work with us, I can also say that these companies have to have been in business for over 100 years, and they have to have never once missed a dividend payment. That means during the Great Depression, World War II, the tech bubble, 9/11 market crash, even coronavirus, these companies that we work with always paid a dividend. Now, you can use Index Universal Life for infinite banking. The only downside there is if you want to put money in and take it out, pretty quickly, you're going to pay some type of a charge, like a 5% charge, to be able to access that money. So that makes it not necessarily the most attractive. If you want to put money in and take it right back out to use it to purchase assets, then a dividend-paying whole life insurance policy is probably what you're looking for. So first of all, what exactly is a dividend? A dividend is just, in the life insurance, it's the portion of the profits that the company has made, and they have to return to the policy holders. So there's two types of insurance companies. You have stock companies and you have mutual companies. So stock companies would be companies like Transamerican, Mutual of Omaha, Aetna, AIG, Aflac. Pretty much all the companies out there you've heard of are more than likely stock companies. There's nothing wrong with stock companies. We use those all the time. We use them for IULs. We use them for term policies, mortgage protection. We use them for final expense, life insurance, all that stuff. They're great companies, but they're owned by stockholders. So their financial obligation is to make money for stockholders. So a mutual company is owned by the policyholders. So think of it this way. At the end of the year, they've got this dividend they have to pay out somewhere. If it's a stock company, they're going to pay it to the stockholder. And if it's a mutual company, it's going to go to you, the policyholder. So their obligation is to make money for the policyholder, not the stockholder. So just a few people in history that have used this. That you can Google tons of stories of insurance companies that helped or started or improved somehow a company. And Walt Disney was one of my favorite stories. And essentially, he already had Mickey Mouse going, and that was a national hit. But he had this dream of building Disneyland. And he goes into a bank in the 30s and he says something like, I want to borrow money to start a business. They said, well, what's the idea? And Walt said, I want to build a magical dream castle for toddlers. And they kicked him out of the bank, said no, couldn't get the loan. And if you look up the story, he actually, I believe, got kicked out of 8 or 9 different banks. So he goes to his financial guy, and the guy says, that's what life insurance is for. It's a vehicle to grow wealth so you can borrow money from it and use it for whatever you want. So that's what he did, and that's how he started Disneyland. That's the same thing Ray Kroc did with McDonald's. It's actually how J.C. Penney saved his company during the Great Depression. He couldn't make payroll, and he took out a loan from his life insurance to make payroll so he could keep all of his employees. Doris Christopher, a lot of people don't know her, but she borrowed a very small amount out of her whole life policy, and she started a company called Pampered Chef. She grew it into such a huge organization that you'll never believe who owns it to this day. And his name is Warren Buffett. You know, the like 85, what is he, 90-year-old investor, like one of the smartest minds of our time. He bought it from her, I believe, for $900 million. You'll have to fact check me on that. And then the Rockefellers. The Rockefellers were the first registered billionaires in the country. And, there was actually the Vanderbilts who at one point had more wealth than the Rockefellers did, but the Vanderbilts used traditional banking methods where you have an amortization chart and you're paying interest and you have to make a payment or they're going to come take your stuff. And about 4 generations later, the Vanderbilts had actually run out of money. The Rockefellers, I forget what generation we're on by now, 14, I think, something like that. But they're actually still one of the wealthiest families on the planet today. So very, very savvy businessman. And then presidents. I don't get into politics, Paul, but whether you like presidents or not, I will say that just about all of them have used some type of infinite banking. And it's not necessarily because they know all about it or they're the brightest all the time. It's that they have good advisors behind them telling them what to do and what's in their best interest. If you look up the story, Biden actually used his mutual whole life to fund his presidential campaign. I'm not sure how much it costs to fund a presidential campaign, but I imagine it has to be a lot of money. So before we really get into it, the big question I ask people is, what do banks do with your money? And people say, well, duh, they loan the money out at a higher interest rate than, they're saying, yes, that's correct, they do. But there's a step before that. So banks invest money in something called BOLI. That's bank-owned life insurance. And there's actually an updated list. It gets updated every 3 months. You can find it here on my website. And that list is a report from the FDIC that shows how many banks own BOLI and how much they have. So if you go to my site and you click right here, how much BOLI the banks own, here's a list. So there's 3,800 banks on this list, and they own a little over $209 billion of life insurance as an asset. Now, I have people argue, oh, that's not why banks own BOLI. They do it so that whenever the CEO dies, they make lots of money. Well, sure, but like, why would they need to do that? They do it as an asset, according to the FDIC, because one, they have to have so much of their money in tier 1 capital. So when you walk in a bank, it says member FDIC. That just means that your money is insured up to $250,000. Well, SIPC is a little bit higher rating, making your money tier 1 capital. And life insurance has that rating. It's actually one of the only 2 or 3 things in the nation that get the tier 1 capital rating. So there's that list. There's just a little graphic of it. And then essentially, here's you and me putting money in a bank in the form of, let's say, our paycheck. The bank is investing it in BOLI, and they're earning 10%. And then they're loaning it out to people for houses and cars and house remodels and debt consolidation and credit cards and all these different things. And they're earning about a 500% return on investment. Then as a thank you for us loaning the bank our money so that they could invest it and grow it, they give us back 0.01 to 0.06%. So that doesn't sound very fair. So like we're the short end of the stick. So what I'm showing people how to do is replace the bank with a dividend paying whole life insurance policy. I'm not saying banks are evil. They're a business. That's how they make money. I'm not saying don't have a bank anymore. So don't misunderstand. You have to have a bank because you got to pay bills, right? You got to pay for groceries and gas and the electric bill and car payments and whatever. But if you thought about it, your paycheck right now is going into a bank. They are just investing it in life insurance, earning 10%, and then using it for loans and making 500%, then giving you back 0.03. So is it doing you any good to have your money in that bank growing at 0.03 or have it in your own bank growing around 10%? I would rather have my money growing in my own bank earning 10%. So here's what that looks like in the case of buying a car. I figured everybody kind of, has bought a car or knows how that process works at least. There's 3 ways. You can finance it, you can pay cash, or you can use infinite banking. So if you finance it, which is what most people do, you don't have the money to buy the car, so you go in the hole. Well, 5 years later, you've made payments, and let's say you've paid off your car, but now your car's got 140,000 miles on it. You're ready for a new one, whatever. So you go in the hole again. It's a never-ending cycle. You're just constantly buying a new car. All right, well, then if you look at, people go, well, that's why I pay cash. I don't have a payment. Well, yes, you do, because you didn't wake up and just have money in your account to go pay cash for that car. So let's call that payment into your savings account. Let's call that your payment. So then one day you have enough money in there, you make the purchase. Now, guess what? You got the asset, you have the car, but you don't have the money. So you got to save. That means you got to make payments back into your savings account, because every 5 years, again, you're probably tired of your car. It's got a lot of miles, it's beat up, it's something. You're ready for a new car. So there's really no difference in the two, other than the red line, you're actually paying financing charges to a bank, and the green line, you're not. So if you use infinite banking, as your money grows, uninterrupted compounding, and you're making those payments, you essentially are loaning yourself money to buy a vehicle and making a profit off yourself when, if, or how you choose to make a payment. So here is an actual vehicle, right? Jeep Cherokee, 35,000, 6 months. This probably needs to be updated. 60 months of payments. There's your car payment. So in reality, if you use just a simple calculator for car loans, you paid a total of, let's call it $40,600. On a car that was $35,000, you paid $5,600 in interest. You didn't earn anything. The bank made $5,600. So if you use a simple uninterrupted compounding interest calculator and you put in that same car over 5 years at 5%, which is what you're loaning yourself the money for, then you're actually profiting $4,000 versus losing $5,600 to financing. So you can also use this for lifetime income. We can get into a lot of this, later on. But one question I like to ask people is, would you rather have $1 million right now in a briefcase, or a penny that doubles every day for 30 days? Now, a lot of people are sharp. They know there's a catch. They know that there's a trick somewhere. So they go ahead and pick the penny. But 99% of people that I ask that to, they say $1 million. I give them 2 seconds. I'm like, all right, you got 2 seconds to make a decision. Do you want $1 million in a briefcase right now, or a penny that doubles every day for 30 days? And they say $1 million. Here's $1 million in a briefcase. It's not that impressive. And then here's the penny that doubles every day. All right, it goes from 1 to 2 to 4 to 8. By the end of day 10, you got $5. By the end of day 20, you have $5,200. And by day 30, you have $5.3 million because of uninterrupted compounding interest. So if I were to compare this to, let's say, a 401k, if you had $100,000 in a 401k and you borrowed $90,000, you're only earning interest on the $10,000 that's still in that account. And you have to start making immediate payments back into that with interest, right? Now, with this, it's not exactly how it works. When you have $100,000 in your account and you borrow 90, you're still earning interest on the full 100. Because what really happened is that $90,000 came from the general fund of the insurance carrier. So you're using what I call OPM, which is other people's money, to buy things like vehicles, rental property, whatever. For me, I race cars, I teach track racing, so I make money with a car. So to me, that is a productive asset. For most people, that is not a productive asset. That's probably a dumb purchase. You should probably make something, purchase something that's going to generate more wealth for you. So even Einstein understood this and said, compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Okay, so here's me, 45-year-old male, non-tobacco. You can see I'm putting $2,000 a month in, and I dumped in $100,000 the first year. So the neat part is you technically have 7 years to dump that in. You don't want to do that. I mean, I want to put that in the first year. Whatever I put in the first year dictates how much I can put in every single year after, if I wanted to. So if I made that much money and I got a bonus and my taxes, and I dumped all that money in here, I just want to show you what it would look like if we did that for 5 years. So we're paying the $24,000 a year. See, you got to think of this not as an insurance policy, but as a bank account. This is a good banking alternative. When people think of this as a life insurance contract, which it is, then they think it's a bill, right? Because that premium that I pay isn't mine anymore. It goes to the insurance company. I don't ever get that back. So with this, it's a little different. You're putting that money in a bank and it's growing, and you still have access to it. In fact, the money that you put in as a lump sum, you have access to about 90% of that at all times. So when you put this money in the bank right here, so you have 124,000 going in year one, and if you'll notice, this is under guaranteed. The guarantee is 4%, which is about every one of the companies we deal with. Then you have the dividend I was talking about. So the dividend on these companies that we work with are between 5 and 6%. So I'm just going to say 6 to make math easy. You're getting 6% here, and you're getting 4% here. When you add those together, you got 10%. So the reason I said I can't call this side a guarantee is because it is a dividend, and dividends are not guaranteed. However, if you remember, I mentioned to work with us, these companies have to have been in business 100 years and have never missed one. So, I mean, short of Jesus coming back, I don't see a way that they would change all of a sudden and start missing dividends. If you look here, you put in $124,000, and then you, I say immediately, usually within 30 to 60 days, mine was actually set up within a couple of weeks, you have access to the total net cash value right here, which is $108,246. So you can put in $124,000, have access to $108,246 almost immediately. So let's say you did take out $100,000 that first year, and even though you want to make a payment, because when you do, the insurance company is making a little interest, you're making a little interest, everybody's happy. But let's just say you never paid that off. And let's say that you died 10 years later. So you're 55 years old and you bought something for $100,000 and you never made a payment. Your death benefit is growing rapidly. Look at that. It goes from 1.8 million to 2.1 to 2.3. I mean, it's growing about $300,000 a year, right? So down here, it's worth $3 million. If you never made a payment on that $100,000 loan that you used to buy that rental property or whatever you purchased, all they're going to do is take that 100,000 plus their portion of the interest out of your death benefit. So let's call that $100,000. Instead of 3 million, somebody's going to get more like 2.985621. So I think they're going to be more than happy when they use this to purchase things like rental properties, and they had income from those properties coming in. And then they also had a massive death benefit that was growing and growing and growing. So another question that I get asked is, well, do I have to pay this forever? And no, you do not. In fact, you can stop making payments into it anytime, just like a bank. You can even take it and start living off of the dividends. You can have the dividends pay you each year. You can have the dividends go in and purchase paid up additions, which is most common. So let's just say that you turn 60 years old and you said, man, I just don't know if I want to pay this $24,000. Well, this is called your increase in net cash value. So right here, where you're putting 24,000 in, essentially you got back 68,125. So I don't know of anybody that wouldn't give me 24,000 if I was going to give them back $68,000. That's a pretty good return. Now, what if they don't have the 24,000? What if times got tough and for some reason they're thinking, man, I'm 60 years old, I'm trying to retire here, and I don't have access to $2,000 a month. You have $1.1 million sitting in the bank. You could even borrow the premiums from this, essentially pay the premiums, collect your 68, take 24 out of that, and put it back in your bank to pay off the loan. There's so many ways you could use this. It's mind-boggling. I mean, and the fact that hundreds of companies have used this throughout the last couple hundred years to either begin or enhance or save their business is mind-boggling. Another thing, if you look down here, if you notice your premiums start to go down. Well, that's because I did a 20-year term rider. The reason we do a term rider is because term insurance is very cheap. And what I'm trying to do is increase the overall face amount of the death benefit. See, agents are paid on the whole life portion. And if you look at a breakdown here, the goal is to keep the whole life portion as small as possible. So when we look right here, the base policy, what the agent would be paid on, is a $220,000 face value policy. Now that costs $1,000 of your $2,000 payment. Then we have a 20-year term rider on here. So that rider added $1.4 million of face amount, which allows us to overfund this policy without it becoming a modified endowment contract, making everything taxable. So this is your level premium paid up additions rider. This is actually your bank account where your money is growing. So to keep this thing in force, kind of like an IUL we've talked about in the past, you have flexible premiums. So with this one, this person said, I want to put $2,000 a month in. The policy then says you have to put in $1,279.96 so that the policy doesn't lapse. That's to keep it open. So that's the flexibility in the policy. You could technically pay anywhere in between those amounts. So going back up here, if we looked at, let's say when you are in your 70s, this 20-year term rider drops off. We went from 3.7 to $2.4 million. What I'm looking for is, even though I dropped the term, does this continue to grow? It does. Does the cash value continue to grow? Yes, just as rapidly as before. That tells me the policy is set up correctly. Did we really miss anything by losing, almost $1 million here in the death benefit? No. You didn't call me saying I'm looking for a massive death benefit so somebody gets money when I die. You said I want to grow and generate wealth and be able to access my money. So you start with 1.8, and even after the 20 years, you're still at 2.4. So you're still well better off than you were when you started this. But this amount drops a little bit because we dropped the term. And then to prevent it from mecking, your policy is going to drop even more. And now all you can put into it is about half of the payment. When you turn 75, it goes to zeros. You can't put any more into it. So if you look at what you're paying in and what they're paying you with the increase in net cash value, you're going from 24,000 in each year and 60, 70, 73, 79, 83. All of a sudden, you pay a little less and it jumps up to 89. Then you pay a lot less. You pay half, and it's still paying you 84, 91, 100,000 a year. So that is how these things work. You can use it to make purchases. Anytime I buy something that's more than probably $1,000, we just had a dishwasher break, right? I didn't know a dishwasher was $1,000 nowadays. So you can actually borrow money out of this, and you can go pay for that dishwasher for $1,000, and then take that money out of your bank and just put it into the infinite bank to repay yourself. See, if you use your own cash to purchase that dishwasher, you now have the dishwasher, but you don't have the $1,000. Whereas if I use OPM, I am having the insurance company buy me a new dishwasher. Does that make sense?
Absolutely.
But again, you don't really want to use it for necessarily that's not anything I would call an investment that's going to grow my money. I would rather use it to buy things like an asset that's going to generate me wealth. But still, the premise is the same, the idea is the same, and how to use it still works the same way. What kind of
and you have to have clean dishes too, so that's important.
Exactly. So what kind of questions do you have, Paul?
No questions, just definite fascination with the IBC concept. I think it's remarkable, and definitely people need to learn more about it. So I'm glad we're doing this podcast. My biggest takeaway really is that it allows us, the policy holders, the individuals, to earn money on our own money versus the banks and other institutions earning money on our money.
Definitely.
So, I think that's a fantastic way to go, and so financially beneficial for people. So I'm happy to introduce this to many people, and hopefully we'll see some people take advantage of it.
Absolutely. If you do want to get a hold of Paul or myself, you can just leave a comment below and we'll reach out to you as soon as possible.
Sounds good. Well, thanks so much, Shannon. And again, everyone, for attending our 2024 podcast of It's Your Life.